Hello and welcome back to the Note. We continue to see stock markets in the West do really rather poorly. The Dow Jones Industrial Average, assuming you care about that, is actually now down for the year. The S&P is up barely 1%. The German DAX index has had a correction of more than 10% now from its peak for the year. The FTSE Euro First 300 in dollar terms is up barely 4% for the year. Generally a sign of momentum being lost across the West. Meanwhile, in China, the Shenzhen market is up more than 100% for the year so far, and the Shanghai Composite is up more than 50%. And yet we are talking about an event tomorrow that could actually add a lot more fuel to the fire. This is the Shanghai Composite and how it's performed over the last 10 years. You can see it's already had one epic bubble that burst, and plainly we are in the middle of a move upwards that looks quite a lot like a repeat of that. It might not be. It might just be our temptation to expect trends to repeat themselves, but that's what it looks like. Now, if we take a look at Chinese import data, a good, clear truth teller of exactly how much the Chinese economy is consuming, a really quite worrying picture emerges once you look at that on a 12-month rolling basis, which is the more valid way to do that. You can see that other than a few months during the worst of the crisis in 2009, this is the weakest import growth, in fact it's negative, that we've seen in the last quarter of a century. Plainly something is happening to the Chinese model. And yet, what we may well find when MSCI, which is in charge of the most important benchmark for emerging market equities investment across the world, they will announce their recomposition of their index on Tuesday after the market closes in New York. It's highly likely that they will at last start to include A shares into that index, Chinese domestic stocks, even if they're very much less than a full weighting. That would encourage very many more people, or force many people, to add to the excitement in Shanghai. If we take a look at what has been in the MSCI benchmark over the last 20 years, you can see that there's been great changes over that period. Mexico at one point was the biggest. Brazil at one point was the biggest. China, which was only admitted back 19 years ago, is now the biggest. Whatever happens, you're likely to see its weight in that index increase to almost 30%. Whatever happens, there will be very much more incentive for investors to buy China. Now, there are two arguments again about this, both valid. One is that the Chinese A share market is now huge and liquid in terms of the futures activity. There's even more activity in volume in Shanghai than there is here in New York in the S&P 500. It seems therefore really rather ridiculous that they're not included in the index in any way. Against that, many international investors haven't trusted the Chinese rally, haven't been involved. This has been driven mainly by domestic investors. There really would be a lot of people who would be caught on the wrong side of this trade, who would be forced to start buying at already high prices, even at the very gentle way in which MSCI is approaching this. The risk that this will contribute to what already looks like a bubble is very significant.